If I told you that for the first 7 years, your investments would feel like they're not working at all, would you still start? You put money in every month, skip dinners out, drive the older car, and watch friends post vacations on Instagram. Then you open your brokerage app and think, seriously, all that sacrifice for this? If that sounds familiar, you're not bad with money. You're just standing in the flattest part of the compounding curve, the part that is designed to feel like it's failing. Everyone sells compound interest like a magic trick that turns a few $100s a month into a million. But when you actually invest, reality looks very different. You check your account after 6 months and the growth is almost embarrassing. A year passes and the balance has barely moved. 2 years in, you start wondering whether all the financial advice you've heard is just hype. Meanwhile, people around you are buying cars, going on vacations, and enjoying their money right now while you're sacrificing for a future that feels impossibly far away. That gap between what you expected and what you see creates real frustration and makes you want to quit. Here's the truth most people never hear: compounding is supposed to feel slow at the beginning. The same math that eventually builds serious wealth makes the first several years look unimpressive. Understanding why that happens and when it changes is the difference between giving up right before the breakthrough and actually getting the results you're capable of. There's a simple framework for this called the 7531 rule. Once you understand it, your whole relationship with investing changes. The first number is 7. That's the minimum number of years you need to stay invested before compounding starts to feel meaningful. It's not random. It comes from almost a century of market data on things like the S&P 500. Imagine you invest $10,000 into a diversified portfolio, earning around 10% a year, roughly the historical average. Year 1, your 10,000 becomes 11,000. On paper, that's a $1,000 gain. In real life, it feels tiny because you could have earned that by working a few extra shifts with no risk and no waiting. In year 2, 11,000 becomes about 12,100. 2 full years of discipline and you're up just over $2,000. Meanwhile, the stuff you wanted to buy 2 years ago is more expensive because of inflation. Technically, the math works. Emotionally, it feels like nothing is happening. By year 3, you're around 13,300. Year 4, about 14,600. Year 5, roughly 16,100. 5 years of saying no to yourself. And your gain on that original 10,000 is only about $6,000. This is the point where most people quit. They look at the sacrifice and decide it isn't worth it. They tell themselves compound interest works for other people, people who started with more money or got luckier, and they cash out to finally buy something they can enjoy today. Then they miss everything that happens next, because years 6 and 7 are where the curve starts to bend. That 16,000 becomes roughly 17,700 in year 6 and about 19,500 in year 7. Now you've almost doubled your original 10,000 without adding more, and your yearly gains start looking bigger than your early year gains combined. After that, the shape of the curve really changes. From about year 8 to year 12, that account grows from roughly 19,000 to around 31,000. By years 13 to 17, it jumps again, from about 31,000 to roughly 50,000. By year 20, your original 10,000 is around $67,000, and you haven't added a cent beyond what you put in at the beginning. Same return, same market, completely different result, simply because you stayed long enough. Compounding is exponential, not linear. Exponential curves look flat for a long time and then suddenly shoot upward. Around year 7 is where that upward bend becomes obvious. Historically, if you look at rolling 7-year periods in the S&P 500, there has essentially never been a case where someone who stayed fully invested for the full 7 years ended with a loss. Short-term investing is gambling. 7-year investing is wealth building. But just knowing I should stay for 7 years is not enough. Because if your portfolio is built badly, you won't emotionally survive those 7 years. That's where the second number comes in, 5. 5 is the minimum number of different investment categories you should spread your money across so that you're not just betting on one thing. Most beginners do exactly the opposite. They throw everything into whatever has been hottest lately. Tech stocks are on fire? All tech. Someone says small cap value outperforms long term? All small cap value. The problem isn't that these categories are bad. It's that no single slice of the market wins in every environment. Concentrating in one place makes you vulnerable to exactly the kind of loss that triggers panic. A basic 5 category structure might include large cap quality stocks, value oriented companies, reasonable priced growth, mid and small cap opportunities, and some international or global exposure. These buckets behave differently as the economy changes, so when one is down hard, others may be flat or even up. That matters because the biggest risk to your wealth is not the market itself. It's how you react when the market gets ugly. If you've put everything into one hot sector and it drops 50%, you're much more likely to sell at the worst possible moment. If you're diversified across 5 categories and your overall portfolio is down 15 or 20% while some pieces are still holding up, you're far more likely to stay calm and stay invested. Diversification doesn't give you the absolute best return in any one year. It gives you the highest chance of still being invested when compounding starts to accelerate. The third number in the rule is 3, and this one is psychological. 3 stands for the 3 emotional phases that almost every long-term investor goes through: disappointment, irritation, and panic. Disappointment is phase 1. Your returns are positive, but they don't feel like they match the sacrifice. Maybe you invested $10,000 and earned 7 or 8%, while your coworker brags that their risky bet tripled. The math is fine. Your emotions hate it. Irritation is phase 2. This is when your portfolio seems to go nowhere for a long stretch. The market drifts sideways for 18 months. Your balanced portfolio returns 3%, and some stock you didn't buy goes up 40. You start to feel like you followed the responsible advice and got punished for it. Panic is phase 3, and it's the most dangerous. Now, your portfolio is actually dropping. Headlines scream crisis. Every time you check your account, you see a smaller number. The logical part of you knows markets have recovered from every crash in history. The emotional part is convinced this time is different, and the only way to be safe is to sell. That moment, not the crash itself, is where most wealth is destroyed, because selling at the bottom locks in the one thing the market can't fix for you: realized losses. Think about 2008, the 2020 pandemic crash, the 2022 bear market. Every one of them pushed people into selling near the lows, only for markets to recover to new highs later. The reality is that corrections of 10 to 20% happen almost every year, and drops of 30% or more show up roughly once a decade. They're not bugs in the system. They are the ticket price for long-term returns. If you accept that going in, those 3 emotional phases don't disappear, but they stop catching you by surprise. The last number in the rule is 1. 1 stands for a simple annual commitment. Every single year, increase how much you invest by at least one meaningful step. That might be 10% more whenever you get a raise, or a fixed extra amount you add on your birthday every year. Whatever it is, it has to be automatic and it has to grow over time. To see why this matters so much, picture 2 investors. Both are 25. Both invest $500 a month. Both earn the same long-term return. Investor 1 keeps that contribution flat for 30 years. They put in $180,000 of their own money and end up with a portfolio of roughly $1.1 million. Pretty good. Investor 2 starts the same way but increases their contribution by 10% each year. Same market, same time frame, different habit. After those same 30 years, they've contributed about $340,000 and have around $3.2 million. Not slightly better, almost 3 times more wealth, simply because they kept turning the dial up. That single annual increase feeds more raw material into the compounding engine and keeps your savings rate aligned with your income. If your income rises, but your investments stay flat, you're quietly investing a smaller and smaller share of what you earn. The one in the rule fixes that. Put all four numbers together, and you get a very different picture of wealth building. 7 years gives compounding enough time to bend the curve upward. 5 categories protect you from concentrating in the wrong place at the wrong time. 3 emotional phases stop being scary mysteries and become milestones you expect. One annual increase quietly accelerates everything as your income grows. Remove any one of those, and the system gets fragile. Combine them, and you give yourself a real shot at letting the math do what it's designed to do. In practice, here's what it feels like. The first 2 years feel like you're throwing money into a hole. Years 3 and 4 feel cautiously hopeful but still slow. Years 5 and 6 bring the heavier doubt. I've been doing this for years. Shouldn't I have more by now? Then year 7 arrives, and for the first time, your investments start adding more in a year than you're adding from your paycheck. By year 10, your money is working harder than you are. Somewhere around year 15 or 20, you realize you've built something real, not because you were smarter, luckier, or perfectly timed the market, but because you stayed in the game long enough for compounding to finally show up. Compounding feels painfully slow, right up until the moment it doesn't. The 7-5-3-1 rule tells you why it feels slow when it speeds up, and what you have to do so that when the curve finally turns upward, your money is still there riding it. The wealth you're building might not be obvious yet because you're still in the flat part of the curve, but the curve is real, and if you stick with it, you will experience the steep part for yourself. If this changed how you see your own investing timeline, do 2 quick things. First, hit subscribe to Naomi Capital and turn on notifications so you don't miss the next breakdown on money, debt, and investing. Second, drop a comment and tell me which part of the 7-5-3-1 rule is hardest for you right now. Staying invested for 7 years, diversifying properly, handling the emotional roller coaster, or increasing your contributions every year? Your answer will show you exactly where your next level of wealth is hiding. And I'll see you in the next video.